welcome to today's webinar. We're looking into building a resilient portfolio with exchange-traded funds. And we have two industry-leading experts with us today. Welcome, Peter. Welcome, Alan. Thank you so much for coming to think about this lovely topic that we're all been waiting so much for. How are you guys doing today?
Very good, Denise.
Very
All
good,
right.
Denise. Thanks for having us.
Absolutely. So our guests are quite excited. So let's get things rolling. But first question to open up for everyone is really what risk management techniques could investors use when engaging in this type of tactical ETF strategy?
Thanks, Denise. I'll take that one, and good afternoon. So I think risk management's one of my favorite topics. Being a former trader, it's very, very important to understand some of these techniques, especially when you're doing some tactical stuff. You're getting in and out of positions. And if we start on the left and we kind of work through these different ones.
Mm-hmm.
First up, it's our friend of the show. We talked about it a lot, which is diversification, right? Which is probably one of the most basic or fundamental areas of risk management. And here what we're talking is allocating sort of parts of the portfolio, some in high risk, some in lower risk. You're kind of spreading out your risk across the portfolio. So you can put some in sort of high risk and return assets, but it's always good to sort of spread things out so you get a good diversified mix. And I think we've got a great slide later on showing just the different returns of different asset classes over time. It's kind of never the same one at the same time, so it's always good to kind of spread things out. The other one I'll maybe talk about is risk budgeting. And again, I talked about a little bit about that. It's all good to put some of your portfolio into some high risk stuff, but just have a budget for that. So
Mm-hmm.
again, keep some in safe and have and just allocate some sort of budget to different areas. Stress testing is another one I like to look at. You can play different scenarios of what could happen. Again, for me, obviously the worst case is if something really does underperform. Is that okay for your financial plan, for your long-term outlook? I think that can really help sort of draw out some vulnerabilities for different asset classes. Again, more speculative, like, okay, what's the worst could happen? I could potentially lose all of it. That could help you with that risk budgeting and your asset allocation, right? Okay, I can put a small amount into that or whatever you need to do. What else we got here? Rebalancing. I think it's
Yeah.
really, really critical. So keep an eye on the portfolio, come back to that desired asset allocation, go back to your budgeting, your stress testing, and just as that regular rebalancing helps you sort of trim what's done really well, maybe add to what's not done so well, and then you can use that as a good technique. Monitoring and review, again, I think it's always good to look at what's happening. I think we'll talk about some ways in the later, some ways to look at how your portfolio is performing and to judge it. So I think that's always a good thing to do. Hedging instruments, again, I think we're going to talk about that in a bit. I think Peter's going to give us some good color on there. You can use derivatives and other such things from in tactical scenarios to help that. The other one on the screen there is stop loss. So that's a great technique. It can help sort of limit losses or preserve profits as well. So I think all of these are great. You can do one, you can combine them. I think it's always helpful to look at a few different techniques and whatever works best for you.
Yeah, absolutely. And I'm happy you brought up stop loss. I did wanted to dive a little bit deeper into that. As self-directed investors, we have access to this type of order strategy. So how can stop loss orders and in the scope of portfolio diversification and helping out with risk management, how can we employ that with our ETF strategies?
Yeah, it is a great tool. We'll go
Mhm.
through some of the pros and cons of different types of stop losses, but if we maybe just start off with what a stop loss order is, typically for all of I think the investors on the line, it would be used to protect against a security which declines in price. So for us, that
Okay.
would be called a stop sell order.
Okay.
So again, I think what you're trying to do here is protect your profits that you've made or limit against losses. So what happens is, and I think you've got some great tools on your website to kind of
Mhm.
really precisely explain how you do this. But a pure stop loss order, when a security or an ETF drops to a certain price, it automatically puts in an order, a market order to sell your position. And you can play around with the prices and the exact amount of shares you wish to sell at that price. What we would suggest though, and we can get a little bit deeper here, is that rather than a market order, which kind of puts it into the market and just sells whatever price, we
Hmm.
would suggest in a diversified ETF style product, use a limit. So a stop loss limit order. So we can jump into an example. You buy 100 shares of an ETF for $100, so you've got 10,000. If you're trying to protect your investment there, and if you're willing to accept maybe a 50% drop, so it goes to $50, you could enter in a stop loss limit order to do that. Now, if the price breaches 50, you sell all of your shares at a market order when it breaches. But sometimes what you can see is flash crashes or sort of a V style event where the market
Hmm.
rapidly sells off, but then bounces back rapidly, and there's some reason that can happen. In that case, you might sell your shares for way below 50 because the market's dropping so quick. If you put in a limit, say for 48,
Yeah.
you'd start to put your limit in to sell at 48 and no less. So that at least sort of gives you a kind of a firm level you're willing to sell at. And if the thing bounces back, then you're all good, right? There is a risk that it doesn't execute because if it's so fast declining, then it might not actually execute at 48. So there's a couple of pros and cons there, but it is a great technique. Again, if you have those kind of technical levels of the market that you're willing to sell or protect your investment, it's a really solid technique.
Thanks for explaining that. We do offer an entire webinar session dedicated to learning about stop loss and stop orders. So if anyone's interested, it's called Trading Essentials 2. Alan did a great job in trying to summarize it in the next couple of minutes. So hopefully that piqued a bit of an interest. But let's explore a couple of other ones here. So, Peter, I want to bring you into the conversation. With the different market conditions, they're always evolving. And this can impact the ETF's performance in a lot of different ways. What are some common indicators that reflect these types of shifts?
Well, are you referring more to how we should adjust our ETF strategies in response to market conditions or the actual indicators themselves?
A little bit of both. So, what can market
A
conditions
little bit
kind
of
of?
both, no
Yeah.
problem. Look, I like to split those up in two different ways, Denise. Like,
Okay.
so first off, I think it's always really, really important to assess your ETF holdings regardless of market conditions. All
Hmm.
right, you should always be doing that. All right, are they doing the job? Are they underperforming? Are they overperforming? Are they delivering that performance in a way that's consistent with what you expected from a risk perspective? There are countless of questions you can ask. Now, when market conditions change in a dramatic way, so positively and negatively, there can certainly be a need to adjust your portfolios, right? There could be a need to adjust your ETF strategy. So, for example, we're in the middle of a bull market. So, you know, are we now a little bit too exposed into equities?
Hmm.
I think that's a question somebody has to ask within their own portfolio, right? Or when the market dips and then we're in a bear market, is it time to actually take some of that cash we have, under the mattress and then kind of redeploy it back into the market? So in those situations, adjusting ETF strategies are really important when attempting to optimize returns and manage your risk. But one thing I will say though, and I find it's really, really important to do, when you're adjusting these positions, make
Hmm.
sure you're doing it within a set plan. Try not to deviate from those investment objectives that you set forth for yourself. And by that, I mean, be careful if making drastic changes, right, to your entire portfolio. Going extreme and selling everything you have and then completely raising cash, or conversely, taking all your cash and going all into the market can almost be more like gambling as opposed to investing, right? But regularly rebalancing your portfolio to maintain a desired asset allocation, that can make a lot of sense. And actually, it usually does make a lot of sense. So, and it's absolutely necessary, especially in changing market conditions. So I guess at the end of the day, it's a long way of saying, Denise, like, stay informed, but stay
Okay.
disciplined. All right. And when making larger than usual adjustments in your ETF strategy based on market conditions, just try and assess that that your decision is, you're kind of taking it's impartial, and you're taking the emotion out of the equation.
And with these common market indicators in mind, how can this really influence when we're trying to adjust it? Can we expand a little bit further on that?
Yeah, well, look, when it comes to indicators, right, that's a tough question. You know why? Because
Mhm.
there's no shortage of indicators that investors can monitor. all right, when it comes to guiding the tactical decisions that they're making in their ETF portfolios, right? Now, don't get me wrong, right? I mean, there are certain ones that a lot of people follow, right? Like, when Fed Chairman Jerome Powell speaks, or the Bank of Canada is considering a rate reduction, or employment data, right? These are certain indicators people are looking at, and a lot of people like to trade or maybe adjust their portfolio in anticipation or in reaction to that news, right? But I also strongly believe that, market indicators people follow, or any kind of economic indicators, it's a very personal thing, right? Now, one of the reasons why I feel the ETF market has grown exponentially, especially in this last decade, is because so many investors, all right, whether they're do-it-yourself investors, whether they're retail advisors or institutional investors, they have their own investment philosophy. They have their own secret sauce, so to speak, on how they determine what ETFs they want to buy and how they want to adjust it accordingly, right? So now that we have over 1,500 ETFs listed in Canadian exchanges, I mean, there's probably at least one ETF out there that can suit an investor's need, regardless of what indicators they're actually looking at to determine what ETFs they want in their portfolio. But I'll end it here and just say that I think one indicator, though, that I'm pretty sure most investors pay attention to, regardless of whether they're individual investors or institutional investors, I think the indicators they look at is their asset allocation. If your asset allocation that you predetermined for your own portfolio, meaning your equity weightings, your fixed income weightings, if that falls out of balance to your investment objective, well, that in itself is an indicator that people should make tactical ETF decisions so that they can maintain that discipline.
So taking a look at what is overweight, and again, making those changes to kind of rebalance it back to their core.
Yeah, that's a perfect way. Denise, you could have answered that question in 15 seconds.
No, your explanation was a lot better. So let's look into a little bit more about income or value and growth type of ETF investments. Alan, if I can get you to answer this one for us, how can investors balance income focused exchange traded funds along with growth oriented strategies in their portfolio?
I think, Denise, it kind of comes down to where you are in your investment journey, your life,
Mhm.
and really what your goals are. Now, kind of broadly speaking, a typical plan would probably be more to invest in that growth type of ETF earlier in life, and then gradually sort of transitioning your portfolio into value and income as you get older. And as we get to the promised land of retirement, you probably want to have that aim to transition that into pure income. And again, we will hopefully we'll get a paycheck from that and retire from work, but not the paycheck, I think, is the ultimate aim, right? So we grow our nest egg and then we take the income from it and live happily ever after in retirement. And I just wanted to call out Daryl Diamond at this point. And Daryl's the dynamic retirement income strategist. He's written tons of books and has tons of resources on our website. You can check him out on the Dynamic Funds website. He always talks about the paycheck portfolio, and then like
Mhm.
as you're later in life, transitioning into that paycheck and living off that paycheck. So there's tons of stuff on that. But with that, my general thoughts are a couple of things. I think balancing income value and growth strategy definitely makes tons of sense. A couple of things to consider. One is that core and satellite approach, right? So you might want to
Yeah.
use some income funds as like your core, that regular
Yeah.
stability, regular income. Then you can surround that with some value and some growth depending on kind of your risk appetite. And here you're trying to make those capital gains, right? So your core is for the income, that stability, and then you layer in some gains on the side of it. I think another thing you can do is that income reinvestment. So rather than sort of taking the regular dividends or the income out of the portfolio, what you can do is set up reinvestment plans. I know I trade offer them and others out there offer them. You can take that and automatically reinvest it. And that's the beauty of compounding. And that's a Warren Buffett, the snowball running down the hill.
Mhm.
You gradually build that influence and you get that magic and what is it, the eighth wonder of the world, which is compounding.
Yes.
But again, if you don't need the income, if you do need the income, of course you take it. If you don't, disciplined reinvestment, and before you know it, like you're compounding those. And the last thing I would say, maybe just keeping an eye on what's happening in the economy. Okay, so stay informed about sort of inflation, whether like are we in a bull, are we in a bear? You can flip that optimization between the growth value and income pretty easily. But those are a few thoughts I have on that one.
Yeah, absolutely. And just to bring up a couple tools that we have easily accessible to us within our Scotia Online, is you can compare funds, right? That's the best way to see is through apples to apples. You can pull up our ETF fund comparison, put in two different funds to see how the performance was, changes in value, can take a look at their different fundamentals. And to speak on that automatic contribution, that reinvestment plan, we as investors have it readily available at our fingertips. Can actually hop onto the platform, and there is a dividend reinvestment portal that we can access and take a look at which investments, which ETF is providing us dividends, and make that informed decision to make that compounding or that reinvestment plan right away. So some things that we can have action about it immediately. I want to explain a little bit more since we're talking about income generating ETFs. Could you explain a bit more? What are some examples when we hear income generating ETF? What does that actually pertain?
For sure. And I think there's a ton of different ETFs that will provide income, and they kind of range from sort of traditional to liquid alts to
Mhm.
multi-asset, and kind of the sky's the limit. But we'll maybe start basic and then kind of work our way up in complexity.
Okay.
So with like basic, not basic, but like the traditional way of getting income on an equity side would be to buy a bunch of dividend paying stocks, wrap them in the
Okay.
ETF, and then when the companies, the big firms are paying high dividends out, collected in ETF, and they're in turn paid out to ETF shareholders. Now you can get those guys both with active management, so here you're sort of paying a fundamental active management to go and pay those, go and find the best dividend payers. You can get it in passive where they're sort of doing a quantitative screen. There's tons of different flavors, but that's kind of one of the equity ways to do it. Then of course there's our friends in fixed income. So there are bond ETFs as well. Again, here you're buying through the ETF a portfolio of different bonds, and they pay interest to the bond holders, which is you as an ETF shareholder. In turn, you collect a proportion of that interest paid out. Now, generally, there are a ton of different bond ETFs out there, but generally the higher credit risk, so going into high yield or more risky loans and paper, you're compensated with a higher interest rate. So there's no free lunch, it's a little bit more risky, but you can get really, really decent yields in the high yield market, for example. That's very different to sort of a very stable Bank of Canada, probably isn't going to pay you as much. Don't forget though, you have some interest rate sensitivity, so you've got duration and other factors to consider when selecting,
Mhm.
but it's a great way to clip a coupon in a bond ETF. What else we got? We got preferred stocks ETFs, beauty of the Canadian market, right? Now these ETFs invest in preferred shares. They typically pay a little bit higher dividend and interest than just plain common stocks. They can be fixed or floating coupons. Again, you can get actively managed preferred stock ETFs, or you can get managed again.
Mhm.
What else we got? We got real estate. All right, so rather than going buying a property and getting a rent, you can get access to a super diversified portfolio of REITs, so real estate investment trusts wrapped in a very convenient ETFs. Now these guys, they basically buy a portfolio of real estate trusts. Again, you're collecting effectively 3 layers down, you're collecting rent, it's going into the REIT, it's going into the ETF, and ultimately ends up in the ETF shareholder's pocket. Great diversifier, a little bit different, a little bit alternative, but a great consideration without needing to go buy a building and rent it out. It's super easy in your iTrade account just to buy one of these guys. Now going a little bit up in complexity, we've got covered calls and options ETFs. Again, ETFs that hold portfolios of stocks or bonds, they're writing options on them. They're collecting those option premiums and they're paying them out and generating additional income. And again, you can get some really, really good yields through those covered call and options ETFs. Now, last but not least, if you want a bit of everything and don't want to go and sort of do your due diligence, you can get those friend of the show multi-asset ETFs. And here you're sort of paying a portfolio manager to go and buy a little bit of everything. So some bonds, some covered calls, some prefs. Again, you're sort of diversifying, you're spreading risk around, and it's a convenience of someone else having to do that for you. Typically, it'll probably be an ETF of ETFs. So you get one ETF, it's a high income ETF or whatever it is. It'll go and buy a bunch of different bonds, equity ETFs to generate a yield. So those guys are good if you're just looking for that ready meal type approach. So that's a few different ways.
That's awesome. Now, many investors are going to be interested in tapping into emerging sectors like clean energy. What are some effective ways for investors to gain diversified exposure to these rapidly evolving areas in the market?
Yeah, no, absolutely. Great question, Denise. And one area which is really interesting in ETF world, so to speak, are thematic ETFs. Um, Look, let me start by defining them. So I define thematic ETFs as one step past sector ETFs. So I'll give you an
Okay.
example, right? If you look at something like sector ETFs, like technology. So the tech sector, if you have a technology ETF, it means that the ETF will hold a basket of securities that represent tech stocks. So, your Apples, your Microsofts, your Googles, and everything. Now, with a thematic ETF, right, it could be kind of like a subset of a sector like technology, as you mentioned, artificial intelligence, blockchain technology. So they would invest in technology securities, technology names that are consistent with artificial intelligence or blockchain technology. So ETFs are excellent vehicles to get that target exposure in a somewhat diversified ways, right? Since ETFs tend to hold a good number of companies within the portfolio. So they can still be, in a way, a little bit risky because, it is a more concentrated portfolio in a specific theme, but it really should be less risky than buying an individual stock to represent that theme, right? So it does give you those diversification benefits within that thematic, and you're not at the complete mercy of the firm specific risk of one stock. Now, there are tons, all right, tons of thematic ETFs, like, you have renewable energy, regional banks, you had marijuana, if you remember, they still have it.
Yeah.
And they're not necessarily limited to subsets of sectors, right? I mean, it could be a theme, an actual theme like ESG. I think
Mhm.
we've heard of ESG, right? And these are ETFs that will buy companies that are focused on environmental, social, and governance issue. I would even put Bitcoin, and crypto into that bucket, right? So there are countless themes out there, and the growth of ETFs has allowed investors to get access to those themes in a very convenient and a very low cost way, and in a more diversified way than if you actually had to go out there and try to locate that individual stock that you want to use as representation for that entire theme.
And to follow up on that, could you share some insight on how thematic ETFs are designed to capture the potential of these different sectors? What could investors look at when exploring these different opportunities?
Oh, look, when looking at that, I always like to try to define it as, what are the benefits and what are the
Hmm.
potential drawbacks, right? So if you look at the benefits of sector ETFs or even thematic ETFs, right? The benefits are is that, again, it gives you exposure to pretty much any sector in a low cost and diversified way. ETFs are fantastic vehicles for that. Um, you also have you also have more and more sector strategies out there in ETF world that are no longer set it and forget it, right? So in the past, you only had passive, sector ETFs that would invest in companies in the sector, but only weight them by market capitalization, weight them based on their size, and they kind of set and forget it. Now, as the ETF industry has evolved, you have a lot more ETFs out there that will give you exposure to the sector, but you'll have a professional, or as my colleague Alan likes to say, you don't have a robot controlling it. You actually have a
Uh-huh.
PM with a certain expertise, that will go out there and buy and sell and analyze the securities and talk to the CEOs and do an industry analysis in the hope of actually giving you better exposure to those sectors and those themes. So that's a huge benefit, and also I would say, a lovely part of the ETF evolution, if you want to speak, right? There's a lot more of those type of strategies that exist. The drawbacks, though, can occur if an investor only has a few of these sector ETFs representing the vast majority of their portfolio. All right. And that goes back to the old, are you diversified enough question, right?
Mhm.
The issue with that, if you call it right, it looks great. But if you don't have adequate representation of many sectors in your portfolio, you might actually miss out. You might miss out on opportunities that, broader mandates might pick up for you. So I look at that as being a potential drawback if not using sector ETFs properly. But another benefit I like as well is that a lot of people like to go towards stuff like S&P 500 core ETFs. And there's nothing wrong with that, by the way. It's a great index that's existed for a long time. But one issue, not just with that index, but other indexes, that sometimes indexes are underrepresented. I'll use the S&P as an example. I heard a colleague of mine, he gave me an interesting stat that the entire real estate sector and utility sector had a lower weighting in the S&P than Apple.
Oh,
Okay, there's Apple, right? So when you think about that, right, if there's an opportunity in real estate and an opportunity in utilities, let's just say that, these kind of defensive names are in vogue, or they tend to do well when interest rates tend to fall. You don't necessarily have that representation in a broad-based index, and sector ETFs can be a phenomenal way for you to get that exposure.
I see.
So benefits and drawbacks, but you know what? They're great investment tools for a portfolio.
And given in today's market uncertainties, investors are often looking for many different ways to manage risk to help stabilize their portfolio. Alan, can you share how ETFs can play a role in enhancing diversification that are key component and how it can help in reducing volatility in different market conditions?
In terms of, yeah, how can ETFs help? I'd say probably a couple of things. One is there are so many different ETF on every single one of these themes or markets. Just
Hmm.
purely having that at your fingertips to be able to diversify your portfolio across different sectors and different areas of the market is tremendous. I'd also say the benefit of ETFs is being able to access international markets. Now, we haven't really touched on that at the moment, but there's about 100 billion of the overall Canadian ETF market, which is 500 billion, is in international ETFs. And to me, that is
Mm,
one of the key things that ETFs have allowed investors to do, is to diversify and get access to different things. And it's the beauty of the ETF vehicle that's done that, right? It used to be the big institutional investors that could go and access these local markets. You'd have to have enough size and scale to do that. You've now got that ability at your fingertip with the iTrade app. You can go trade the whole world through the convenience of the ETF. And to me, that gives probably a few things. One, it helps spread your risk, all right, your just geographical risk. If you're just investing in Canada, I'm a proud Canadian, although my accent might tell I was from overseas originally. You're just getting access to Canada, right? If you're investing in Europe and the US and other different countries, again, you're kind of spreading that geopolitical risk out across the world and the economic risk around the world. I think the other thing ETFs help, international ETFs help with is sector diversification. Again, I love Canada. Our market's pretty unique though, right? It's banks and energy is really most of what our stock market is. That doesn't always work. It works a lot of the time. Don't get me wrong. I love the Canadian banks and I love our energy companies. But if you want, again, that Nestle example, that Swiss listed stock, that's a great stock, great business, right? There's a ton of great businesses around the world which can help kind of with that sector diversification. So when financial energies are off, maybe consumer discretionary is a great way to access that. And last but not least, sort of you can enhance your risk and perhaps reduce your return. So things like emerging markets may be on fire when developed markets are coming off. Again, having a little bit of that blend helps kind of offset some of the risk if you're just looking at the Canadian markets. So to me, that international aspect of ETFs is one of the key benefits of the structure.
And since we're looking at performance as markets and as our own personal goals start evolving, with tracking the performance or success of investments, I was wondering, what are some effective ways for investors to monitor and evaluate the performance of their ETF or their strategies over time to make sure that it's aligned with that objective of theirs?
Denise, it's report card time, is it? Um, there's a few ways you can look at this, right? You can do your own little report card when it
Okay.
comes to your ETF investing. I think first off, if you just look at a single ETF, right, just a single
Okay.
portfolio, you can look at its performance against its stated benchmark. Now, every investing vehicle will have a stated benchmark. You can find that on the website, the ETF fact sheets. I'm sure you guys have got tools to do that as well. You can click through to the issuer's website and find what the benchmark is, and then
Hmm.
see how the performance has done versus that stated benchmark. And again, that's to me one of the report cards for the individual ETF strategy. How did the manager do? Did they outperform? Did they underperform? And also, did they do it steadily? or was it
Yeah.
sort of cramming the night before exam, load of performance, and that was that. So you have a look at the kind of the risk. To me, that's kind of the risk. Are they spending a ton of risk to achieve the index returns, or are they sort of modest and they're outperforming over the long term? One thing I would say though is don't be too quick to judge on the old performance. Sometimes even the best strategies can underperform for short periods, but if you extend the time period, there's a clear sort of outperformance
Clear.
trend, which again, most investors are longer term for their core. The other thing is just bear in mind your overall ETF strategy, right? If you've put a position on which is designed to protect if the market's ripping up, just have that in mind when you're looking at the overall performance away from like a single. If you're looking at your portfolio, you've set it up defensively and growth is ripping, you're going to
Hmm.
underperform, right? Like market's up 20%, you're over 7. Just remember why you had that in there and what you'd set the thing up for. What else? Oh, income. Yeah, we talked a lot about income, right? Incomes. I did this myself actually the other day. I looked at my iTrade account and I was
Hmm.
down on one of my ETFs. I was like, crikey, that doesn't look right. And it's because it paid a ton of income out. So
Ah.
you gotta bear in mind, right? If you, especially on a bond ETF, it's paying a coupon out. Generally, that means the NAV's going to move down, but you're getting compensated because you've taken an investment out, you've taken cash out. So just have a look at the total return. So your mark to market, your capital appreciation, depreciation, but also include your dividend in there. And that should, if
Mm.
you put the two together, that could change the picture a little bit as well. So those are a few things that I definitely think about when I think about performance.
And there's one thing that we haven't touched too much on, but from a broader perspective, how can ETFs be used as a tool for hedging against these types of tricks and turns that the market's playing with us or providing us?
No, that's a fantastic question, Denise. And also, this kind of goes back to say, like, the lovely thing about the evolution of the ETF industry, again, is that ETFs have evolved where many types of hedging instruments have been created to serve that purpose, right? To
Hmm.
help mitigate risk and to help reduce volatility. So, on your screen, you can see alternative investments. So a few years back, a category known as liquid alternative ETFs started to gain a lot of popularity in our industry. Now, as you can see on your screen, right, there's a wide array of different types of ETFs that fit into this bucket. My screen's a little small. I think there's one that says hedge funds or hedging. I can't remember, but I'll just use that one as an example, right? So one type of ETF that you find that now exists on the market are long short ETFs. All right. So which combine long position in stocks and or bonds, and then combines short positions as well in stocks and bonds. Now, obviously, the long positions are meant for companies that are expected to go up, and of course, short
Hmm.
positions are meant for companies to go down, right? And there's a dual hope of stabilizing overall returns and also being able to capitalize on a down market, right? Which is obviously a great hedge. If your returns are stable in a down market, or you're even making a little bit of money on a down market, I can't imagine a better situation than that. So I think Alan's going to discuss some of the limitation of these type of products in a few moments, right? But those are individual holistic solutions that have those hedging strategies embedded within the ETF itself. Now, when it comes to things like sector-specific risks, it's funny. Denise, I love to subscribe sometimes to the keep it simple, stupid mentality.
Yeah.
Sometimes, just being diversified. Just being diversified and investing in other sector ETFs and ensuring that you have adequate representation in various asset classes that don't move in tandem with each other. It's very rare that asset classes in different parts of the market always outperform or always underperform, or they don't all outperform at the same time or underperform at the same time. Therefore, you have, the benefits of diversification if you're adequately weighted, you know, in a lot of those different sectors simultaneously, right? So sometimes that's just the way to go, right? It's definitely less costly And it's a great long-term strategy for that. And also, look, I mean, there's other things out there as well. You know, in ETF world, like you have inverse ETFs, you have short ETFs. They're designed structurally to move the opposite direction of whatever sector or whatever market they represent. So those can be hedging tools, but I always caution people, know what you're getting into. Okay. You know, those are interesting ETFs, no doubt, but you have to kind of understand, oh, what happens if I don't call it right? What happens?
Mm,
Like, am I using enough? You know, how do I use these in my portfolio? So there's a lot of questions that you need to ask and analyze before using these. So again, tons of stuff out there right now, Denise. Our ETF industry has definitely expanded over the last 10, 15 years, no doubt.
perfect. And I do want to bring Alan in to wrap this part of it up to talk about the limitations, right? What can you walk us through some potential cons of using this hedging strategy? What are the limitations to that?
Sure, we can talk limitations. And as I think you know, Denise, I'm a recovering broker-dealer and trader at heart. And I wish we often talked about it on this, there was a universal hedge for everything,
Yeah.
right? And you just simply clicked a button, protect all downside, it's only upside. For me, that was the S&P futures. It didn't always work. I think the point is, right, that there is no perfect hedge for
Okay.
every single scenario that you can. I think you just got to accept that, right? This is the economy we're talking about. It's very, very complicated. There's a bunch of interconnections. So even with the diversity that Peter talked about, there is no sort of perfect hedge for every single scenario, even with 1700 whatever ETFs we've got. But so I think I'd say that. What else have we got here? Yes, ETFs can be low cost, but some of those areas that Peter talked about, particularly the double levered stuff, some of those liquid alt stuff like that, just check the MERs and the cost of using them can be quite expensive. So potentially those costs can add up, right? And that might eventually outweigh the actual benefit you might get, right? So just bear that in mind. The other one is like over hedging, over trading the portfolio, right? Sometimes you can fear that fear factor and sacrifice all your potential upside. So one sort of comforting factor that I have is that stock markets in the long term generally rise, right? Generally, if you look at the history of
Mhm.
capital markets, they always over time go up. It's a comforting thought to have, right? That yes, you can hedge and you can position portfolio for certain outcomes, but generally sometimes doing nothing could be a good thing.
Now, thank you so much for answering all these lovely questions of mine. We've had such a wonderful session with our guest speakers here, and thank you. It's always been a pleasure.